and you know the Bank of Japan, the BOJ's bid for these bonds is going to be removed, what's going to happen to the price of these bonds? They're going to collapse, and they're going to collapse overnight, very quickly. And the bond market is international in nature. So when JGBs collapse, so will European debt, and so will the U.S. debt. And everything that's been pegged, we have 96 months in the United States, 96 months of a virtual 0% interest rate policy. And that has sent everybody, every investor, pension funds, hedge funds, everybody is in a mad dash for yield. So when yields spike in Japan, and they spike in Europe, and they spike in the United States, everything that's been a proxy for yield is going to crater. So yes, you're going to have a bond market collapse and a stock market collapse globally.
Silver investors could make a fortune. Billionaire Eric Sprott and other top gold analysts predict that silver will dramatically outperform the yellow metal. In order to maximize your exposure to silver, consider shares of Golden Arrow Resources trading on the TSX Venture under GRG and the US as GARWF, where insiders have accumulated 50% of the company, and billion-dollar giant Silver Standard Resources has taken an 8% stake in the company. This company has 250 million ounces of silver resources and is headed up by the one man who is responsible for the largest silver deposit discovery in history. Learn more at crushthestreet.com/silver100.
Hello, everyone, and welcome into crushthestreet.com. I'm Kenneth Amaduri, and I'm joined with a returning guest, Michael Pento of Pento Portfolio Strategies. His website is pentoport.com. This man's a thought leader in the financial industry and has a plethora of insight to share with our readers. I'm sure of it. First of all, Michael Pento, thanks for joining me today.
Thanks for having me back on.
Michael, first off, we're around the corner from the IMF inclusion of the yuan in the SDR basket, and I'd like to get your thoughts on this. Is China relinquishing any power by signing up for this global initiative? And is this in line with a one world agenda? And is China now part of it?
Well, let's just talk about how it affects the value of the dollar. So we have what I would call a very consistent erosion in the use of the dollar in international trade. And not only is the yuan going to be part of the SDR, but also we look at Saudi Arabia now going to be having the right to be sued, and I think appropriately, by 9/11 victims. They have an awful lot of FX reserves that are in dollars. And an awful lot of that is in Treasury. So, you see this trend towards a weaker U.S. dollar, people going outside of the use of the dollar in international trade and selling treasuries to repatriate currency. So this is something I think is going to be long-term very negative for the U.S. dollar.
Okay. So is this something, and how does it impact the U.S. long term? Is the U.S. going to fight back, or is it something the U.S. wants? Why is this a good thing? Why is this, who's in control of this situation, or is the U.S. losing control?
Well, they're losing control. I mean, the U.S. has had, ever since Bretton Woods, had complete domination of international trade, commodity trade, and basically the ability of running huge current account deficits, trade deficits, $800 billion a year in trade deficits, and not having the dollar fall in value because of the Bretton Woods arrangement. That has been slowly eroding. 1971 was a big turn down in the use of the dollar and its hegemony around the world. And now we see more and more global economies, global countries moving away from the dollar as a world's reserve currency, and I expect that to continue.
So where does this lead? Is this something the powers that be are okay with as we move towards this? Do you see it as a one world system, or is it the U.S.
Well, it could be. It could be we're moving towards one world government, one world currency. That's theoretical. I'm more interested in how to trade it. How do we trade this? What's going to happen? What is the real watershed event? And the watershed event your viewership should be cognizant of is that the Yellen led Fed is going to have to assent to the notion that they cannot normalize interest rates without absolutely sending the dollar skyrocketing higher against the alternative currency policies, monetary policies of the ECB and the Bank of Japan and the Bank of England. And also, look at GDP growth. If you look at current dollar, nominal GDP growth, or if you look at real GDP growth, we're running about 1.5%. That's about half of the growth rate that we've seen since 2010. That means the Fed will not be able to normalize interest rates as they've been threatening to do over and over again. And once the world FX traders understand that the Federal Reserve cannot embark on this path of interest rate normalization, then the dollar will tank. And not only because interest rates will, on nominal terms, will be capped, and where they are, they might even be lowered, going back into QE as the U.S. enters a recession, but the specter of stagflation grows more and more salient as time goes by. And as I said, if you look at core inflation running about 2.3% year over year, and real GDP growth growing at just over 1%, that means that inflation on the core level is running twice as hot as real GDP. That is stagflation. So I look for the dollar to lose its purchasing power. I look for that condition to accelerate once the Fed admits that it cannot raise interest rates and joins the other central bank regimes in keeping interest rates low and even going back into QE. That's what you have to look for. That's the tradable event.
Michael, I want to get your thoughts on this. It's kind of a philosophical type understanding. You know, we have the bond market and the stock market both at extremely high valuations. So how do both the bond market and the stock market get overvalued simultaneously when historically they operate with an inverse relationship?
Well, I mean, maybe they do operate historically inversely. They didn't do so in the early 80s. When you had both stocks and bonds in a bull market. But I could tell you this. Why do you think that if you look at total market cap to GDP, we're at nosebleed, a very thin air section of history, just the second highest ever of all time. If you look at median PE ratios, they're at a record. If you look at price to sales, second in history. So why are we so high, and why are bond prices so high? Well, the answer is very simple. Quantitative easing around the world. Central bank balance sheets have gone from $6 trillion in 2007 to $21 trillion today. And they are increasing the amount of money printing. That's high-powered money, base money. That supply is growing globally at the pace of $200 billion of QE each and every month. So they're buying everything. They're buying bonds, they're buying stocks, they're buying ETFs, and if the sovereign risk-free rate of return is pegged at zero and negative, we have about 25% of the entire sovereign debt pool in the world trading with a negative yield, and that extends also to corporate debt now too, because don't forget, over in Europe they're buying corporate debt, and the Bank of Japan is buying corporate debt. So you have negative yielding sovereign debt, negative yielding corporate debt. And all of this is because central bankers are trying to create inflation and getting growth from inflation. Well, growth doesn't come from inflation. Growth comes from productivity. Growth comes from a growing labor force. It does not come from inflation. In fact, inflation is a growth killer. So it's not a mystery to me. Don't let anybody ever tell you differently. The Bank of Japan owns 50% of all of their government debt. The ECB is buying corporate bonds. 30% of the investment-grade debt is now trading with a negative yield. So there is no real market left in the world, and it's all manipulated by governments and central banks. That's your answer.
Michael, so then if the stock market is people traditionally invest in, and then when the stock market falls, the inverse trade would be the bond market. If they're both overvalued...
Well, no. Let me stop you there. I know exactly where you're going. Here's the problem. The stock market's going to fall because bond prices are crashing. Bond yields are soaring. So bond prices go down, yields go up. So if the progenitor of the stock market correction and crash, if the progenitor of that chaos comes from crashing bond prices, then you have the two of them going into the toilet together, and that's what I'm afraid of. That's what I hedge. That's the fat tail event that I'm so worried about. I wrote a book about it called "The Coming Bond Market Collapse." I invest and hedge against such a collapse. Listen, let me just give you a brief scenario. So the Bank of Japan, as I said, they own half of the Japanese government bond market. They've now decided to pin the Japanese 10-year note at 0% forever. They have no time limit on this. And they actually are going on record saying that they want to have an overshoot to the 2% inflation target. So let's just look at this mathematically. So if you have a 0% or less rate on the 10-year note, going out 10 years, 0%, you get less than 0 on the 10-year note, and you have an inflation rate that's going to be well above 2%, and you have a nation that has a debt-to-GDP ratio of 250%, so you're basically insolvent mathematically. So what happens when the Bank of Japan decides to change its monetary policy and signals to the world that they've met their inflation targets, and now it's time to unwind these policies, stop buying as much JGBs as they've been in the habit of doing? So now you have a bond market that's a 10-year note, and all these yields below on duration, from sort of 10 years to down to the overnight lending rate. All of these are negative. And so you have a 2.5%, 3% inflation rate and a negative 10-year, and you know the Bank of Japan, the BOJ's bid for these bonds is going to be removed. What's going to happen to the price of these bonds? They're going to collapse, and they're going to collapse overnight, very quickly. And the bond market is international in nature. So when JGBs collapse, so will European debt, and so will U.S. debt. And everything that's been pegged, we have 96 months in the United States, 96 months of a virtual 0% interest rate policy. And that has sent everybody, every investor, pension funds, hedge funds, everybody is in a mad dash for yield. So when yields spike in Japan, and they spike in Europe, and they spike in the United States, everything that's been a proxy for yield is going to crater. So yes, you're going to have a bond market collapse and a stock market collapse globally, concurrently, and that's what lies in the future, and that's what I'm so concerned about.
Michael, so then what is the new inverse trade? If they're both overvalued, what is the new inverse trade? Going back.
Well, I'll tell you what I'm doing. The inverse trade then is when bonds collapse in price, yields go up, and when stock prices collapse, then you want to head for shelter. And my inverse trade is to short the market and to own gold. That's the inverse trade. Because let's look back in 2008. In 2008, the Fed funds rate, that's the overnight interbank lending rate, was 5.25%, 525 basis points. And when the stock market melted down, the Fed did what? They started very quickly to unwind their nominal yield policy of 5.25%, taking interest rates down to 0. If we get an event such as what I just described, and I don't see how that isn't inevitable, I can't give you a time frame for it, but I know that it has to happen. When that happens, and I've given you the math behind it, so you have 0% 10-year and you have 2.5%, 3% inflation, yields have to spike not only to at least 3.5%, you have to go to 2.5%, 3% just to equal inflation. But what about the fact that the nation is insolvent? So yields are going to go from 0% to 4% in a very short period of time. What is that going to do to the economy of Japan? What is that going to do when interest rates in the United States spike from the 10-year, which is now about 1.6%, all the way up to 4%? What's going to happen to the housing market? What's going to happen to the stock market? What's going to happen to the economy? So your shelter is going to be in precious metals, and you should have the ability to have someone managing your money that knows how to short stocks, buy puts, or at least own inverse, non-leveraged ETFs.
Yeah. It's great advice right there. Michael, we are seeing uncertainty in the markets here I'm not 100% sure where it's coming from. There's just so many things, with the economy, but the uncertainty, we're seeing gold hold up, but interestingly enough, silver has been pulling back. What is your thoughts on this? What are we seeing, as of the last week?
My visceral reaction there is silver is much more of an industrial metal, and gold is the monetary metal. Gold is money. So, in my opinion, if you're going to have the prospect of collapsing stock prices, bond prices, and economies across the world, the use for silver, I think silver will benefit, but the industrial side of it is going to be very much hurt. So I'm more of a gold buyer than I am a silver buyer.
Michael, and getting into the seasonality of going into fall here, I'm just curious, do you have any inclination to believe that there will be a stock market crash going into the fall, as we've seen so many times in history where the stocks do tend to be more volatile going into September and October?
I'll tell you, September is usually the worst month for the stock market, but crashes usually occur in October. Look, the last 3 quarters of GDP have been around 1%. We've had 6 quarters in a row of negative earnings on the S&P 500. You're very vulnerable here. If there's any hint that earnings are not going to recover, so you got to watch the data, and this is what I also do as a money manager. I'm very much watching the ISM service sector. If that dips into negative territory, we're not far away from that. I'm watching the non-farm payroll reports as they come out. If we have another print that shows that we're headed towards zero and actually shedding jobs, if you have any hint that you're going into a recession and that there will be no recovery in earnings, don't forget, as I said, median PE ratios, price to sales, total market cap to GDP, the CAPE ratio, the cyclically adjusted PE ratio, all of these are in very thin air section of history. So you cannot justify these valuations if you don't have a huge, not a small, a huge rebound in earnings. And as soon as the stock market becomes aware that their rosy, unrealistic earnings estimates are not going to come to fruition, watch out below. So if you watch that data, and that data is going to tell you, hey, listen, we might be in or headed into, and I think we already are in a recession, but if the data manifests itself so clearly, the trading algorithms on Wall Street read recession, and that, like I said, would be a negative ISM services or a really bad print on non-farm payrolls, then there's nothing the Fed, there's nothing the BOJ, there's nothing the ECB or the Bank of England, nothing these central banks can do. They're already going full speed ahead on their printing, and the Fed has nothing to do as far as no room to lower interest rates. So you're going to have a stock market correction in the fall if you get any of those recessionary data prints coming out.
And Michael, a tangent question, just out of curiosity. Is there a fundamental reason why we've seen the stock market be so volatile in September and October? Anything that happens in the economy, or is it a psychological thing that's just become self-fulfilling because people just get nervous around the fall season in the markets?
Well, this particular fall is unique in the fact that we have a presidential election, which I think both of our candidates are going to be very disruptive for the stock market. So the answer to your question is this fall is exceptionally volatile, but I think it's just historically inculcated in the mind of investors that September, October are just dangerous months. And I have no other reason other than that that's the history.
Yeah. Michael Pento, everyone, of Pento Portfolio Strategies. His website is pentoport.com. Michael, if people want to learn more about what you do, reach out to you, buy your books, where would they go and what would they find?
So go to my website. It's pentoport.com, or you can email me directly at mpento@pentoport.com. And the number here for the office is 732-772-9500.
Thank you so much, sir, for coming on the show. I really appreciate your time and your insight, and I'm looking forward. I mean, such interesting times here going into the fall season, and really looking forward to what's going to happen with precious metals, because I'm heavily exposed at the moment. So.
Okay. Well, good luck. Good luck to you.
Take care, sir.
And thanks for having me on.
Well, my pleasure. Thanks for having me.